Greetings, market rebels. Welcome to this week's macro measure. It is Sunday, September 10th, 2023, a little after 11 a.m. here on the East Coast. I'm Wayne, and my partner Ryan's working on some stuff, I'm sure. Let's get our stuff taken care of, and then we'll get into this week's look at the markets. Quick disclaimer on that there for you. And then there you are with the intellectual property rights notice. So with that addressed, here is a look at this week's stream. I'll leave that up there for a few seconds if anyone wants to take a screen capture or whatnot, so they can follow along, or just pause the video and grab one, whatever the case may be. But this is what I'm going to cover this week, and this is what I covered last week. Excuse me, right there. Yeah, so there's last week's stream that we talked about. Just meaning like there's so many things we could talk about. These are the things that we decided to talk about when in one very long run-on sentence almost every episode, because there's just so much out there. But we try to do the best we can to focus on things that are probably the most appropriate at the time as we see them. Anyway, with that, I'm going to reposition things a little bit, and I'm going to stop the share briefly. And let's get out of that presentation mode. Let's move things around. And what I think I'm going to do is just start with a review so I can see things over here. And let me just get my main basic charts going. So where we were last week was starting out with our review and summary. Last week, we had expect more of the same, right? So what we saw here through really the end of August into, this is a SPYs, of course, ETF we're looking at as our proxy for the market. And we saw that back and forth, and we expected there to be more, right? This is nothing new, but this is just a quick review. We did not have a really strong lean, and we said we'll have to wait and see. So the way we've been looking at things is let's just trade off of the recent swings, right? So the week prior, we were willing to trade. If we got through that high, we were willing to run with it. If we would have gotten through a key low, we would have been willing to do that, take the downside. We did have a lot of good ideas, I think, this week in really our basic services. I think happened to have a lot of them, which is good, because basic services are for folks that are newer and that are less experienced, and hopefully a lot of those ideas were easy to handle. And in addition to that, the more experienced folks typically get that information along with the package that they're in. So that means everyone got to participate really in momentum trades and UOA trades. So there was good movement this week, which was nice. It was I felt a little concentrated, but we did get that sort of zigzag we've been talking about in September, and that's really what we've been looking for, and we're just willing to really go with it. And I think, again, we're at that type of juncture this week where how can you really make a very strong case? I can sort of counterbalance a lot of bearish things with bullish things and vice versa. So an example would be, well, we have a higher low in place here versus what we have seen, and that's good. But at the same time, we still have this lower high, and very quickly, if this market, say, reversed here early in this upcoming week, we could be taking out the recent low they tried to pivot from. So you could be right back under pressure quickly. The other side of that is with a lower high in place. The other side of that would be, well, you still have these upsloping long-term SMAs like the 100, the 150, the 200 respectively. So that's a good sign, right? And yeah, I guess you'd have to say I'd rather have that, right? If I'm a bull, I'd rather have that than not have it. But at the same time, is it really that great, right? Is it really great where certain things are? For example, the things we've been focusing on, which is also part of our review, DXY, right? We've been focusing on the dollar and the inverse relationship between the dollar and the equity market. And there you go. And so the dollar didn't have a banner week, but it did kind of hang in there, and it did manage to close just off of the recent high that it made this week. So it made a new high, wasn't a runaway high or anything like that, but it made a new high and closed very close to that. And the 10-year yield that has backed up and corrected a little bit. I think it did get a little ahead of itself. And I know we're talking about it like it's a security when it's really just the yield, but you get the idea, just technically speaking. And so it did kind of really power strongly, did back off to where we thought there would be support, held that, and then it's tried again to it bounced from there, but now it too has a lower high put in relative to this high. And clearly, right, it also has rising SMAs. So if yields keep rising, this has been, I mean, it's kind of as old as time itself in terms of financial time, that, you know, rising rates are typically not good for equities because people, when given the opportunity, people would rather shift to less risk, better return, right? Theoretically, if you're going to have a bumpy ride in equities, and people usually anticipate that, and that's what you get. But that really hasn't been the case, right? It just could keep drawing more people in because we've had really rising yields and a rising market for the most part since the October lows of last year. So something really ultimately has to give with yields and the dollar trying to still maintain uptrends, and equities the same, is just the way I look at it, which is, you know, the traditional, I think, way to look at things. Nothing extraordinary there. It's just that it seems like we've lost that a little bit. So what I'm getting at overall is that you've got to keep your eyes, I think, on the dollar and the TNX, because I think they're going to really, their behavior is going to help play a big role, maybe the most important role, I think, in what equity markets do next. And so if this continues to power up and through, and that to me would mean the equity markets are going to be under more pressure. Same thing, of course, with the dollar. This is why I keep saying, right, you got to keep your eye on this. This is getting crucial, right? Because if we go back in time, you haven't seen, I don't think the yields have been up in at this level, right, for quite some time, right? This is a longer term look at things, and you could see we really have to go back in time to really go back in time, right, to get anywhere close to this. So the economy really isn't built, and nor is the federal borrowing schedule built to really absorb and sustain higher rates, much higher rates for a long period of time. It would seem to be a problem, but so far the markets have done a great job of really pretending that it isn't all that important. And maybe they're right to sniff something out, and there's something that the equity market sees that we have yet to see. Some people would say, well, sure, there's a lot of great things going on because there's this de-globalization situation happening, and you're getting away from all the outsourcing and overseas this and that. And so a lot of those things are being reshored in the USA, and that's going to be great. And it very well may. I hope that that's the case for a lot of Americans that have been, I think, systematically left behind by the powers that be over the last 50 plus years, slowly at first, and then more swiftly in the recent decades. So that would be good news. I'd gladly welcome that. I'm not sure that kicks in as soon as some of these people think. That's what one of my main complaints is over time, is that a lot of these people build these rosy forecasts and developments in sooner than they really deliver. And in fact, the AI situation had that really happen this week, where someone came out and said, you know, look, the interest is certainly there in AI, but the experience people are having with it isn't really as wonderful yet as it probably needs to be for there to be mass adoption, and it just becoming like this, whatever you want to call it, this revenue source, major revenue source for in so many ways and different places. So we'll see. And obviously it could help on the efficiency side with certain tasks and so on and so forth with running companies. And that would also be theoretically good for share prices. So we'll see if that stuff plays out sooner rather than later. But in the real world, in the here and now, I think we've got to keep our eyes on the dollar and yields. The VIX to a lesser extent. At some point, clearly, the VIX will be able to escape, at least momentarily, from its tethered position. There's been a lot of talk over the course of recent years that, hey, this VIX is assuredly been tamped down with sort of artificially, right? With a hand that's not so invisible to many. I don't have all the information on that, but I just wanted to share that we know that that's out there. That thought is out there anyway, but that's why people are saying the VIX has lost its relevancy. But I would suspect that if we do really have another leg off, risk off leg develop, we would start to see the VIX become a little bit more germane or relevant or what have you than it has been for a long time. We'll have to see though. Anyway, getting back to we'll just bring up the cues. I think the zigging and zagging is here to stay. And for now, and I think we should just keep trading it that way. I think with the movement we've seen in the past couple of weeks, the end of August and the start of first full week in September, I think there's been some pretty good movement. I think some of the nimble players that are out there have probably done fairly well with what we've been served up, given right that it's not a runaway market in one way or the other. So that's really where I'm coming from. I still don't think it's easy to develop a strong lean yet. And so whenever I come to these videos each week, or even when I'm evaluating a stock, for an idea or a trade or what have you, I'd like to, of course, arrive with at a high conviction conclusion, right? I really think if it can get past this level and the market is supportive, ideally, right? The winds of the market are supportive, then I think the stock could really do this, right? That's what I like to arrive at, but I don't think I can do that very easily right now. And whenever I have this problem, I would say the overwhelming majority of the time, it turns out to be the right answer. In other words, when you can't get super aggressive with your lean, it turns out that you were smart not to do that. It turns out you were going to probably be served up action that was more challenging rather than just super strong trending action, sort of like in a phase like this one right here, right? Where you get into the earlier stages in May, start breaking out. And for the most part, it's a very nice, strong run for the next, say, 5 to 6 weeks. And that's a lot easier, I think, to trade especially when market breadth is supporting what's going on. And that's the other thing. I don't think market breadth really improved here, right? I don't think there was this. I think, in fact, it probably worsened a little bit. So that's another thing that's keeping me cautious, because that's really not always instantaneous, but I'd certainly rather have it with me than against me. And so that's some of the stuff that's balancing out these longer term SMAs that still remain upsloping. So in a nutshell, this could apply to many sectors too. I would argue that, look, if this low holds and then this starts to work its way up and they break it out above here, you may be breaking through here and then trying to attack the all-time highs in Qs, which were made, I think, last year. Same in spiders. And so that could happen. You just can't say, no, there's no way that happens. Remember, there's a lot of things out there. This is also part of our comments, that there's really a wall of worry, right, that's developing. There's a lot of things. I've been saying it for months, that I don't see a lot of short-term bullish catalysts that are wonderful. I see the rate curve essentially has been higher for longer and may yet still be even higher for yet even longer. And this has been really counter to what bulls were selling in a big way about 6 months ago, starting around 5 to 6 months ago. And that just hasn't happened. And we don't know if we've topped out yet, but we certainly haven't gone down, right? So this is part of the problem to me, is that inflation hasn't died off enough. And this week we have the CPI coming up, and PPI, and of course other reports that are important really in the back half of the week. But I think that you may see there's the potential for things to not just be receding enough. And so that to me would be a problem, especially with the Fed meeting coming up on the 20th. It may create a little concern. They might yet still do something. The expectations right now are highly in favor of them sitting still, right? Staying put, at least in September. Then you've got to get to early November, I think, for the next meeting. And that's expected basically a coin flip. You either sit tight or you go up. by some margin. So which is again not really ideal. So right now, right, you could easily be right back with a very bullish look and potentially breaking out with a good week. At the same time, if they break down and start, they lose this low from last week quickly, they'll have this attempt to rally that was really rejected strongly without it even being able to really do much more upside damage. And you could roll over, and that would look like, wow, geez, that's concerning, right? So this is what I'm saying, is that you may as well, and I don't think I'm going to leave all these lines here, but it would kind of be like this, right? We would say there's a little mini channel. Oh, Thinkorswim is fighting with me a little bit. So this would be our support on the channel, right? This would be our, because I don't want this to get even messier. This would be our resistance on the channel. And we could easily break down below support, and we could easily break through if I just put like a little tiny flattish line up here, if I can get one right about there, just close enough. That would be your breakout, right? This is really going to be, now it's going to be your breakdown below last week's. And you may as well call that the 20 SMA in blue if you want to make things easy, or just use Thursday's low. But these are your points that what I'm saying is you're betwixt and between. And then you're kind of betwixt and between again, in a way, because is it really the end of the world if they break this down, but they put a higher low in relative to here? It's really not. So this market is not in that kind of a phase where it's easy to say we're very close to this or that. I think, every trade should be taken and looked at least initially as this is, I'm planning to be nimble. I'm planning on getting a nice little score. And if more develops, wonderful, but I'm not going to commit the cardinal sin in what could be a zigzagging or choppy market of overstaying my welcome consistently. So that would be my thoughts on how to handle things in the very near future. Now, the caveat I would add is if there's really big, we start to see big selling, and it's for some news item, due to some news item, at least apparently, that sends the dollar and rates up, and it maybe sends stocks down, and it's big, that would be a different story. That would start to say, okay, this could really be the breakdown of, we started correcting really off of this high, corrected into this low. You have this correction of the corrective of this initial corrective phase. So this is corrective of what we saw really in July into mid-Aug. And then if we get another leg, this is what I mean by another leg lower, be risk off leg coming down here, maybe closing this gap, that kind of thing. That would be your potential second leg of what started to unfold here. So we just don't know. And if you look at it, it's really hard to say, again, is this just a nice low? Will we look back on this in retrospect and say, this is a nice low? It was definitely like a nice little low there. They held it, and now it's up and away. And remember, they use the wall of worry. They use obvious things like rates are going higher, right? They use all these things that against people, and that's how they get people off balance. And then, of course, on any whim that they possibly can hang their hat on, that's when the jamming happens. And remember, that third year of the presidential cycle, that is suggesting that you could have more, right? You could have more. Where is let me see if I can get this. I think I've got that. I think we have that in here. Yeah. So here's the third year of the presidential cycle. And that to me is an issue where let me just double check that this has got the right screen. Yes. So remember, right, this is what they do. This is the kind of tough phase that we end up in this year. And remember how they kind of resolved this thing towards the end of the year. So you could have this sort of zigzag back and forth for a while, and then that's when they do their thing. And you could see that once things kind of get really, I guess, hairy in OCK, and that sort of peters out, the VIX comes off, right? And then you can see that the bottom typically gets put in. And this happens in almost every year, not quite every, but almost every year, where there's some sort of a little bit of a pullback at some point in October. This one's deeper historically in the third year, and then you go. It takes you a little while to really warm up, but then you go. So that's what I think we have to look for. Now, here's the thing. I've got a bunch of things that are just going to bludgeon everyone, really. So we'll take a look at these tabs now. But this is just one view over the last, I think, 44 years of data, right? And you can see that September's rough, right, on that view. Here's another view, right, of what goes on from 1928. And you can see that September, again, is rough, right? It's probably the most negative month typically. You can see the ratio of positive versus negative, and it stands out as the worst there. So there's a different way, different time period. Stocks, again, stocks do not like September, right? Here's your September performance overall. So here's what happens, right? If you get involved in each month, trying to participate in each month, and you can see that all three other months that remain in the final quarter, they tend to outperform, right, but September by a long shot, with November being the stellar performer. So just keep that in mind, right? Again, another look at it if you want to look back to 1945, whatever your look back period is. But this is also interesting, this is what I mean by a little bit of the counterbalance. If you look at this, that when you head up by about 10% or greater in your Jan through July, which we did this year, you can see 2023 is active at this point. And then you have an August that's negative, right, where the performance is zero or worse. Well, I guess actually worse than zero, there's no equal to. So yeah, worse than zero. Well, look what happens, right, for the balance once you get past August. So not every year's really stellar, but certainly some of them are. But on balance, right, there isn't one negative. So the mean is 9.9, the median 8.7. They're all positive, right? So all periods are not that impressive, but right, that's because there's a couple that are really super kind of on the low side, right? So just keep that in mind, right? That there's, as bad as it looks, and it does look bad. We already looked at this, looked at that. So let's take a look at some of these kind of just simple market breadth views. Here's the MMFI percent of stocks above the 50. And that, after right bouncing, this had a rough week, what you'd expect with the kind of week we had. The 20, same with respect to the 20 SMA. Again, another confirmation, but this is really not at an extreme, which is when I think it really matters to keep your eyes on them, is when they're at extremes. And here's your 200. So percent of stocks above the 200, that also corrected. Like we said, that could certainly correct a lot more, right? But in the grand scheme of things, would you call it an extreme where it is? And I would say, look, it's probably near the middle of its typical, where it typically is, right? So there's really nothing special there. In terms of rates, we didn't break through, right? So we're still kind of hovering somewhere really near on the 2-year. And we took a look at the TNX already. So your rates are up there, but they're not powering through yet. And so remember, over the course of the last year, when we've been up here, it's been a good trade to really kind of fade this a little bit. However, do notice, right, that this time, when last time they had it up there and above, it was a brief pullback and they came right back after it. And that's always something that I keep my eyes on. Here's your September probabilities. So that I've got as of right now, you can see that there's a 90+% chance we just sit tight, which is what I would expect it to be. We're not getting anything right now in terms of fear, greed, right? The timeline, if it lets me, I'll flip over. And you're in the middle, as you would expect there. There's nothing extraordinary that we could say, well, hey, this is really overdone. It's neutral. Let's call it what it is. This was interesting, though, right? That this survey, of course, comes out, like, I think it comes out sort of midweek or Wednesday and Thursday is what my memory says, somewhere there around that part of the week. And you could see there was a really big bounce back in the bullish. So to me, right, we were thinking this is actually a little bit more bullish last week because of the contra nature of this. But now, like, I'd say, well, geez, that's a little bit more. It's probably a little too bullish right now. They may have jumped a little bit too far too fast, type of thing. So not that great. I don't think from a bull perspective, you'd rather see that kind of smoked like it was, and before you start to get good rallies. This one is another quick thing worth noting, that here's what's going on in terms of bankruptcy filings, right? You can see that those are getting up there. Remember, this, of course, was the extraordinary COVID madness that went on here, which was sort of, I don't know, forced in a way. The other one that we can compare to, though, is the housing debacle, whatever, if you want to call that, in the aftermath of that. So you're getting up there towards those levels. Here is the personal savings rate with the consumer, right? And you can see that here's your credit card, right, debt change. It's just going haywire to the upside, and naturally the personal savings rates falling. And I think this is the last one. I just want to show like how absurd some of these, this is the Fed, and they had St. Louis and Atlanta had this really big Q3 GDP jam at one point, and now that look, they've worked it all the way down to where it's negative. This is why these things are just, I've checked into them here and there, but they're just so unreliable, and they usually just, as Ms. Leduc, I guess is how you say that, as she notes up here, right? It's or whoever she's quoting. Yeah, I mean, this is what happens. It always starts out that I like to see it really start out reasonable and stay reasonable, but it usually starts out very positively, and then they keep revising it lower like everything else. It's just absurd that this is the fantasy land that everybody is willing to go along with, but I guess people feel like they can't do much about it. So, but let's get back to the charts now that we covered the tabs. So that's really where I'm at, and I could even show you this a little bit just to kind of emphasize this point, that even on important sectors, and I think energy is its own thing, especially right now, but you can see that these are two former high flyer sectors, and you've got the same pattern we're talking about, and in those, in communications and also in technology. So it's really hard to say, oh no, this is really the clear way, right? We could come back, this could be a higher low versus here, and they could be working this up. And the same case could be, this could be the lower high, and if they break things down, this could look like a bad area that you failed to get through for the third time. And that's even happening in two other kind of important former leadership areas, which are XLI and XLB, basic materials. So those are also, right, looking a little concerning. So I'll talk about the same things, unfortunately, in sector situation, but here's your transports. They're oversold probably, sure, but that also isn't a good look from an important sector. This is your financials, not a good look from an important sector. So a lot of these sectors are also showing what the market charts themselves are showing, which is that there's really a little bit of this and that. That's why I'm just saying we're betwixt and between. You just really can't, I don't think, get super opinionated at this moment, and you're better off trading with that kind of open mind, like I'll take what comes my way, see what develops, and keeping your eye on the dollar, keeping your eye on yields. That is probably what you need to do first and foremost. And as long as that sort of inverse relationship remains intact, which I would expect that it would, you'll kind of know, okay, this is why things are probably selling off, or this is why things are likely rallying right now. So let's make sure we cover a lot of other things. So yeah, we're still using that. Market could easily pivot in either direction. Just trade, in terms of like getting breakouts, trade the swing high, swing low. We covered those. Really, you can pretty much do the same on last week's low and high, or the prior week's high and last week's low, I should say. But I would do the same thing. Now, if you break out from there, then you can maybe let things breathe. Now, that caveat to that only would be check your preferred indicator in terms of your oscillators, right? If I like to use the RSI, just tried and true in a simple, basic way. And if your RSI on, say, the daily, or I don't even know, like a 2-hour chart, just to throw an idea out there, if those aren't already overbought when you're here, then that's maybe a good sign, right? That you can get a little more, and maybe they can come attack this highest high that we saw this year. And that would really be something, given, right, that if they're able to do that in September, that would really be impressive, because as you saw, this is not typically what you would call a stellar month. So we talked about dollar, and so yeah, dollar and bond yields. I think, right, that would really, if you think that the equity markets, if you're in the camp that the equity markets are not pricing in realities, I think that that's what could really break the equity market, is really that jam job on yields, and that these guys are forced to admit that they were just completely dead wrong about the Fed easing sooner rather than later. Don't forget, though, that everyone knows that. Don't forget that the trends are still in favor of the bulls. And don't forget that the bulls have been able to do some incredible things since the October lows, right? As really rates have gone up, right? So this has always been my experience. And I don't mean it has to always be that way, but I'm just saying it's always been my experience that the equity market is very, very, very reluctant to face realities at key times. And the whistling past the graveyard thing is what I expect as a result of that, because this is really what I've seen time and time and time and time again, where you would think there'd be a little prudence that would seep into people's calculus in terms of their risk exposure in equities, and it really doesn't until all hell starts breaking loose. It's just that really sort of ignore it. Oh no, I ignored it for too long. So just sharing what I've seen over the course of time. Let's talk about once, however, just keep in mind, right, that if the Fed does actually start cutting, believe it or not, right, you would think that would be good. And I guess it is, but the initial take on that is, oh no, the Fed's cutting because they're worried, and then we usually get pretty poor performance just after that. But the best times to buy tend to be after the Fed's been cutting for a little while and the market has gotten walloped. That's when you actually get a chance to make some of the best buys that you can timing wise. That's also been my experience. So just wanted to share that. You have to just wait for the technicals, just like we did in October, about a week after, maybe two, so I should say really about 2 weeks after the actual low put in, we had to start saying, like, look, this is shaping up as maybe the bulls didn't know it would be the ultimate low for now, but it did hold, and there were signs with breadth and so on and so forth. Remember, resistance held again in yields, so they haven't powered through. Again, when the Fed cuts, that's when equity markets usually get rocked for a while before finding a bottom, and that's really a great time to buy, typically, at least in my recollection. I think, right, that the catalysts just aren't there. So this is the current assessment, because I failed to note that. I still think, though, that the stocks are on sale mentality is going to be there, because there's a lot of believers in the presidential cycle and the third year performance that we're in, followed by the second best year, which is next year. The bad news is good news continues to perk a little bit, because they're looking at, right, the way they're looking at it is, oh, if it's bad news, then the Fed really can't do much more. They're going to have to wait and wait it out longer and not go any higher. So they're trying to spin it that way. That's fine. Upside EPS revisions are actually happening. So again, even though breadth took a hit, and that is a little concerning part of the counterbalancing act right now, there are some things that are being revised higher. And so the way I'm looking at that, as I noted, was that the street is, under the impression that companies will be able to stock at the U.S. consumers for a while longer, right? So in other words, we're all going to be subject to these prices that are local in a way, because we know that there's different prices for items in the United States versus other places, which is also, it's what the market will bear. So I guess it's fair in that sense, but we know what goes on. Hopefully a lot of these companies will be exposed for what they do, and I hope a lot of mom and pops supplant them. On a side note, but they are charging people a lot more and reducing product size. Again, that to me is really a bad way to go, but they continue to be able to pass this along, which makes their profits look wonderful. Also, another factor that makes their profits look wonderful is buying back shares. when stock prices are elevated. You just wonder about that, but again, they get away with it. So I think the doors are open to more, again, more upside and more downside in the intermediate term. I don't think with the cycle that's worked so well this year, with the kind of correction we did see last year, with a lot of the long-term trends in the SPY still looking good, right? If you're a moving average person, I don't happen to be one of those people, but I know that a lot of people are. And if you look at this daily chart and you just look at the SMAs, the 50 is still rising. So, and so are naturally the longer terms from there. So nothing really awful is there yet. Could change very quickly. We already talked about that. But at the same time, right, this other factor is here, which is if we look at more of let's look at a weekly chart of the SPY, and I'll try to maximize this. And you know that we're still fairly well off of the highest high. But if we look at this a little bit more closely, you can see really there's sort of this cup and handily weekly situation developing in a way. And this could get through here, and that the next real targets are probably a flat line on the weekly, at least, would be, let's see, 470, but I would ballpark it at about 470, and then all you have left at that point is the highest high. And so I won't rule that out. I know I have confessed that I'm really more of an economic bear, but again, I say it almost every week. I don't trade it that way. I don't see how they're going to pull the rabbit out of this hat, but they always change the rules about things when they're backed into a corner and all the real escape avenues are blocked. That's when there's this, don't forget about, hey, don't forget you have to make my bunk because we're in Italy and it's a Tuesday or whatever they say in stripes. I mean, it's just like, oh no, well, there's this rule that we haven't talked about. You may as well even talk about the tuck rule way back when. But this hasn't been called. It looks like a fumble, but no, it's not, because we want this game to go the other way. But anyway, look, this is your cues, and it's got a similar pattern naturally, right? So I'm not going to say this is the strongest handle. I don't know if the time spent here really relationally is where it should be to officially have a cup and handle type of pattern, but you're supposed to have a more rounding bottom than this point here anyway in a real cup and handle. But again, I work off if it's close enough, and to me visually it's close enough, and I do think, right, that could develop into something. And remember, it wouldn't take them very much to be right back at all-time highs if they busted through. And it might make no sense, and to you, me, it does, but it won't matter, right? And this is how these guys roll. And they're about, right now, they're about 6 weeks away from, if they can hold this market together, they normally start to get the turbos kicking in those last 2 months. And then next year tends to be the second best year of the cycle. So we can't ignore that just because we'd like to, right? I would like to ignore that. I think a lot of that, like, why would that even matter? But these are the probabilities, right, that you're playing over time. Every situation, sure, is unique, but there's also a lot of similarities across time that pop up as well. So it's a tough call, and that's again why we're not super pounding the table right now. I don't see enough breakdown yet in some of the trends to be very heavily bearish and leaning that way technically. So to me, right, that could happen again quickly, but I don't see it enough yet. You would need to see, I think, more damage before I could get really bearish. But at the same time, right, I still think that's the question that you're going to be asking here is, if these yields continue to go, I think that could be, well, are we in a bull market, or are we in are we still in like a longer term bear? Would probably come back, and that would be a big shift from where a lot of people are right now. So we'll have to see on that one. I still would say expect more of the same. Right, just trade again what's in front of you. Don't want to belabor that. I would say at DEFCON 2, because I don't think you're out of the woods and you want to be ready. Because again, if this is just this little, and I'll highlight it instead of just mousing over it, but excuse me, if that sort of channel in here is just corrective of this leg here, and then we have a whole nother leg lower, which I'm calling the second risk off leg, then you could really get down there, right? That could be something that would, to me, it'll make a lot more sense if yields really spike, the dollar spikes, there's problems, right, with inflation not going away as quickly, and the Fed just decides they're going to go a little bit higher, a little further. That's what I would expect to happen. But again, what I expect and what the market's going to do, two different things. That would make sense to me, but a lot of the times the market doesn't make sense, and that's again why I would argue if you're short term and intermediate term oriented, I think you're better off learning about what's going on with the charts and trying to get a handle on that and just trading what's in front of you, rather than trying to insist that your macro take should be playing out, because the market does a great job of ignoring people's macro takes for a long time, including mine. I mean, as part of that. So again, I still think I have a hard time buying what they're selling. That would be bulls. I still hope to be wrong, but that does create the wall of worry. So a lot of the things that we cover here naturally are, they're all known. Not everyone really knows them, but a lot of people, I'm sure, are very well aware of that, and a lot more than that. So these things are not supportive of the equity market, but to this point, right, that doesn't seem to have mattered, which is usually the case anyway. Remember, they do use these calendars, I think, to hide behind. And this week, you've got the CPI and PPI in the back half of the week, along with other, I think, bigger data. And not too far from thereafter, right, the following week, we will have, I think, the FOMC the following Wednesday. So you're getting into a point where this is, this could be very interesting. Now, volatility could sort of seize up a little bit in front of the Fed. You might get a day or two there, day and a half, where, everyone's sort of the tribulation, right? We're waiting for someone to say something, Powell to say something important or unimportant, whatever the case may be. So I'm still concerned. I'm bottom lining it that way. The very final comment would be, as I said, you got to trade what's in front of you. It's the same as it ever was, really. And you just have to remember that to this point, right, at this very Sunday that we're talking about things here, they still have, the bulls, that is, still have these trends in their favor. And as we saw on the weekly charts, there's even like a pretty powerful potentially pretty powerful weekly pattern that could begin to unfold and trace out if they break out through here. So if they break out through here, they're really close to attacking those highs. And that's probably because, right, the bulls have been in control of this market now for, it's about, month 11 here. So it's been a while that they've been in control, but it's probably because these companies are able to get away with the shenanigans, right? They're able to really use all kinds of little tricks to still keep the EPS numbers looking solid, really, even as Main Street continues to deteriorate, right? So I think there's that to me there will be some point at which that game is no longer playable, when people are really, really hurting, and that will be an unfortunate time should it come. But to me, right, that's where this game runs out, and then and I think there'll really be like a lot of anger, like that. This is what our government, our central bank, our media. Well, I'm loath to call them the media, but media. And our corporations really have subjected us to. There'll be a lot of, I think, righteous anger at that point for the mismanagement or intentional mismanagement, however you want to look at it, of everyone's affairs by these, I don't even know what you'd call them at this point, but you know what I'm getting at. So that could be something that occurs, but they might be able to speak out, and for all we know, another good couple of quarters that make everything look just stellar, right, from an EPS perspective. And I wouldn't put it past them, and that's another thing that would keep equity prices. I think equity prices are elevated. Of course, valuations are probably elevated, but because I don't think that the profits, the margins and so on and so forth are sustainable, given what they're already putting people through and how energy's taking a bite out. But here's the diamonds, right? They're not far from the highest high, despite everything. So that's a bigger picture look at those. We don't always do this. They're sort of betwixt and between. You can see this low, this high, and you're just basically, right, you're bouncing around between those two, which are also bouncing. Those are between this one and this one. So you're just not in, right? You're not in anything special, but you have to say, well, wait, what's the trend? Well, the trends are up still. The trends are up. So for now, we could say if they get back above the 50, they'll be above every SMA at that point, which is a good sign overall, and it won't be that far away from taking out this high. So again, despite everything, despite Germany, Europe, despite China, right, despite what's happening, well, in most places, not necessarily everywhere, but in most places, despite all that, right, and despite what rates have done, this is where they have things. And so it's very curious, right? It's not like it hasn't been that way before, though, but very curious, but it is what it is. So this is where the things are priced right now, right? And remember that that's the thing about cutting to the chase with charts, is that all known information by the market itself is factored into what we're reviewing, what we see, what we're analyzing. You know, and I take comfort in that, because it's not I don't have that everyone knows everything, everything's perfect mentality, but I just mean that, right, for now, they don't seem to care in a deep way, a big way, about a lot of things. But having said that, right, this is one sort of odd man out. And so to me, and this sort of makes a lot more sense to me, the way IWM is acting, that it is virtually on the support area that you could see that you're virtually right at the 200, nearly in purple, which is the last of them. I'll just put a casual line through a few things here just to give us right about there. So this could break very quickly. You've got this gap fill down here. That would be at about 176.24 is the high that day. That would be a decent little trade. We'd like to trade this one. We have this a lot in Rebel Pit Pro, and we also have a lot in UOA, because I guess I'm biased a little bit that way. I'll take the hit and not blame Ryan or Greg, but I think it's a good trading vehicle. And so I think they agree, but I think it's a good trading vehicle, and it usually delivers opportunity, right? And that's what we're looking for. So, but this is the odd man out, where it's not really as rosy. And I think, right, that's because of the nature of this being small company components. And right, they don't have the deep pockets. And so they're not nearly as far along as the bigger mega cap companies, certainly, and even just large caps with the Dow or so on, that kind of thing. You can see how far this is lagging behind. And so this has been sort of, right, despite being big picture kind of churny and consolidating, sideways-ish, all that kind of thing, even within that kind of a more narrow range, and sort of like the amplitude is not really all that wonderful there. On the daily, right, it's still really a good trader, I think. But remember, this could fall quickly, fall through, be in trouble, close the gap, right? So that thing's a little dangerous here. At the same time, we say that it's on support. It hasn't cracked the 200. And if it does hold, it's got a little bit of positive divergence, sort of. And it's not quite the same low, but it's showing a little bit of positiveness if it can hold. So maybe there's at least a bounce attempt in the offing. We'll have to see. But that, to me, is the most concerning of the large four that we chart every week. We looked at the dollar. We looked at TNX. We looked at the VIX briefly, I think. I don't want to belabor those. So that would really leave us with mainly probably the big sector, which I'll cover in sector situation too. But these are big, and I think that looks concerning, right? This is one reason why I can't really be bullish, which is this, to me, is SMH could easily start to take out this support area that I've got, this kind of lower part of the support line of this channel that it's in, the larger channel that it's in, and it's failed to get through the mid part of the channel a few times. And that, to me, is always a little bit of I guess you could call it like a yellow flag, right? So that little bit of a yellow flag there, then you start getting concerned that if it does come down, it can't hold, this could be it. And if it does drop, there are other gaps in the chart, but the initial major gap is down near 130. So that would be a really serious correction down to there. So again, I would keep another eye on that one. I've got you looking at a lot of different things, but mainly, right, it's the dollar, DXY, TNX, and naturally you're looking at your major market index ETFs, but also SMH because of the leadership factor and what this is driven and all the hype and optimism about what's going on here. And if that starts to crack, right, that could be problematic, because you can notice that if you go back and look at October, this was one of the first things to really bottom and not look back. And not everything did that. And so that's why, like, this tends to be a leader in my mind, at least recently. And so I would say, look, if this starts cracking, I think that's going to possibly also contribute to a spillover effect that would start to really sour the mood and potentially bring about another risk off leg. So just remember, too, they could treat us to another risk off leg, let's say over the course of the next 5 to 6 weeks, and then still have plenty of time left to put one hell of a end of year markup madness rally together just to get their bonuses and keep the third year and the fourth year on track for even more upside haywire activity. So just keep that in mind, because there's a lot here. And again, as I said, this is not really an unwillingness to get strongly opinionated. It's the fact that there's too many things in my mind that are just unclear, or not enough things that are definitely overwhelming in one way or the other. So you're better off. I think I've had my experiences overwhelmingly when you can't come up with something strong, just wait for key levels to start to come under assault. And then if they break through those, go along with it. Always know that any breakout or breakdown can always be a false one, but you still have to handle things smartly. But that's the thing, trying to force one right now, just not worth it. Wait, let the market really speak to you. Let the market tell you what to do. Just be prudent, be nimble. And I think in the end, you'll be ahead of the game just by doing those and taking that kind of mindset into it right now, rather than saying, oh no, we're about to get back on track, or oh no, the wheels have to come off this week. They could. I'm just saying that I don't think they have to, as long as they hold some of these key things above these key levels that we talked about today. So I hope some of what I've shared helps you out this week or some week in the future. Don't want to belabor this for too much, so I'm going to get things wrapped up here. I'll thank everyone for tuning in. I'm going to record Sector Situation very shortly, and so all this information should hopefully be posted not too far from now this afternoon. So again, thanks for tuning in. I'll catch everyone this week. Thank you.